All right. Hi, everyone. My name is Michael Vogan, and I'm the lead auto economist at Moody's Analytics. For those of you who don't know, Moody's Analytics is a sister company to the Moody's Investor Services. So we handle everything that's not bond-related, including economic research and forecasting, and that's the group that I'm a part of. So what I'm going to be talking about is subprime auto credit. And in particular, I want to try to understand better what's going on in the industry, because I think that there's a lot of concern about how much subprime auto credit is out there, whether or not the securitization of that credit resembles the mortgage bubble leading up to the Great Recession. So to do that, I'm going to use data from our creditforecast.com product, which is a joint partnership we have with Equifax, where we cut the data into all the different slices and then forecast it using our macro models. So the first thing to think about is what kind of subprime credit has entered the economy over the past 7 or so years. I mean, here we have the origination volume by score band for all auto loans and leases in the industry. And what you see is that auto lending obviously took off after the recession, right? There was a lot of pent-up demand and lots of competition. And auto really stood out in the credit industry at large. But the notable thing about this figure is that most of the growth was in the non-prime and prime spaces, right? So throughout this presentation, when I say subprime, unless otherwise stated, it means 620 and below. And the near prime is going to be like 620 to 660, and then 660 to 700. But here, when you look at 620 and below, which is the gray or the orange and below, the originations in that space really mirror what was being originated back in 2007. So it doesn't look like originations have spiraled out of control. It's been a very steady increase over time. And again, like when you have the 10% year-over-year growth, right, like that's coming primarily in the more prime space. One interesting observation is that ever since the middle of 2016, we see originations starting to level off and starting to trend downwards. And that's consistent with general credit tightening throughout the industry. So the Senior Loan Officer Survey, which is conducted by the Federal Reserve, ever since 2016 Q2, respondents have indicated a net percentage tightening in new and used auto credit. So we're seeing originations starting to flatten off in all segments, but in subprime they're starting to come down. So the key takeaway there is that the subprime credit coming in doesn't seem like it's of an abnormally high volume compared to what we were seeing before the recession. The counter-argument to that, however, is, well, look how long this has been going on, right? That credit has built up to an unsustainable level. And when you look at outstanding balances over time, you see that subprime here is about $217 billion as of October. And that's not much higher than what we saw in 2007. So when you see the headline numbers of like about 1.2 trillion outstanding in auto debt, right? Like most of that is near prime and prime. And to address the question of whether or not that's like a systemic risk to the economy, it's true that deeper subprime loans are being packaged into securities at a higher rate. So I think the number was, back in 2010, 5% of subprime securitization loans were deep subprime. Now it's 32%. But in comparison, before the crisis, there was 1.1 trillion outstanding in subprime residential debt, which is the amount of the entire auto outstanding today, right? So like the volumes are extremely different. And in percentage terms, it's not a big share of a lot of the growth that we've seen over the past couple years. The caveat to that, however, is reality is more complicated than aggregate charts, right? So of all the subprime credit outstanding in the economy, 70% was originated through non-bank channels. Here that means auto captive finance companies, independent dealers, monoline lenders, and independent finance companies. And what we see is that that share has grown over time. In particular, subprime lending has expanded fastest in the auto non-bank space relative to history. So here we have the ratio of balances today compared to the pre-recession peak for auto loans and leases originated through non-bank and bank channels, which bank consists of banks and credit unions, compared to the pre-recession peak for each of the different risk score bands. So here you see that in auto non-bank, there's 40% more balances outstanding in the deep subprime space in that segment compared to before the crisis. Whereas in the bank, they've pulled back dramatically in the deep subprime space. They're actually like 30% lower than they were. But then the bank space has grown monotonically across the risk score band, right? So the banks and credit unions really cater to that near prime and prime group, whereas the deepest subprime borrowers are being catered to through non-bank channels. And other data that I've seen suggests that the captives much better resemble the banks and credit unions. So if you look at the auto non-bank, right, that growth, that U, I imagine that to be bifurcated, right? So like this side probably represents more of the captives, and then that side represents more of the independent finance companies and things like that. And that is an important observation when you look at performance, right? Trying to assess like what kinds of loans in the industry are most at risk and why. The fact that subprime lending has grown so much in the auto non-bank space is an important observation. So it's well known that performance is starting to deteriorate in the subprime space. But not all subprime credit is equal, right? So here we have an annualized default rate metric by the different risk score bands in our credit forecast data set. And what you see is that, of course, on average, right, the deep subprime, the 300 to 529, they default at a higher rate, right? And then it monotonically scales going down. However, the notable thing is the rate of degradation since 2013. We see dramatic losses in the deep subprime space. And in the non-bank sector alone, that's worth $39 billion outstanding. So of the $200 billion overall subprime credit, that's a sizable share, right? And they're seeing extraordinary losses that mimic the Great Recession, which is telling because there's no economic crisis going on. And then you see that as you get to the higher end of the subprime distribution, we see performance deterioration, but that's negligible, right? Like that's nothing to be worried about. But it's in these very deep bands that are primarily catered to by the non-banks. They're seeing, and these are defaults, right? So these are terminal losses. These are complete write-offs. They're seeing write-off rates at levels comparable with what we saw during 2009. And the problem is even worse when you compare the same type of subprime borrower between bank and non-bank channels. So this graph represents the default rate spread between each subprime group between loans that were originated through banks and non-banks. So the way to read this is back in 2007, for borrowers with 300 to 529 credit score, the auto non-bank default rate was 5 percentage points higher than that cohort who originated through banks, right? So controlling for risk score, that was the gap between the two default rates. And you see over time that that gap spreads and it compresses. But since 2013, the auto finance loans, or the auto non-bank loans have deteriorated very quickly, and bank has actually fallen over time. So this graph that I just showed with the climbing deep subprime default rates, that's a non-bank problem, right? When you compare it to the bank rate, auto non-bank is about 16%, and auto bank has stayed low at about 8%. So it's not so much the credit score of the borrower, that suggests evidence that it's the origination channel as well, right? There's something unique about the auto non-bank deep subprime channel that's driving these extraordinary losses over time. So to dig into that a little bit, right? So the question is, why are we seeing these extraordinarily high losses in that segment when the economy is good, right? Like we're getting consistent 2% GDP growth, we're late in the expansion, and unemployment rate is approaching 4%, right? Which is close to, if not past, full employment. So the way to look at that is you look at cohorts of that group over time and see how their performance is shifted. So this is cohorts of deep subprime borrowers in the non-bank space originated in first quarter 2006, 2007, 2011, 2012, 2015, and 2016. And this is the cumulative default rate by the loan's age, right? So this tells you the percentage of that group that has been written off at 12 months, 24 months, 36 months, so on and so forth. And you see that, so the deep blue and the green, those are historically some of the worst cohorts originated in terms of credit quality. And they were also deeply affected by the recession a couple years later. So you see that their curve, right, they approached 35% default, cumulative default rates by 3 years of age. Then as you go forward in time, credit contracts, right? So credit that was doled out to borrowers with these credit scores in 11 and 12, much more carefully underwritten, right? And also a deep subprime credit score after a recession does not necessarily indicate that the borrower is a deep subprime borrower, right? It could be that they were just affected by the economic shock. So they could be of higher credit quality on average, right? But you see the credit tightening, so all else equal, the cohorts are getting better. And then you look at 2015 and 2016, and it rebounds backwards, right? So the purple and blue line. So the recent cohorts in this group are performing just as bad as those originated right before the recession. And that's partly because of what I just mentioned, where a deep subprime credit score today means that that borrower has serious financial problems, right? Whereas after the recession, it could just be the shock. And then also, as credit expands, the underwriting policies change, right? They get a little more loose, things get competitive, right? LTVs start to balloon, all sorts of other stuff goes on in the non-bank space. So that's concerning, especially when you consider economic shocks on the horizon, right? This is what we're seeing under baseline economic conditions. If an adverse economic shock were to happen, you'd see these cohorts surpass what we saw back in 06 and 07. However, given the credit tightening that I mentioned earlier, we expect this to start to shift back for recent vintages, right? So if I were to plot 07 2 years later, you might see it between the gray and the blue, and you might see it start to fall back. So the other thing to consider with subprime credit is layered risks, and that's really what we observe to be the biggest indicator of performance degradation in the subprime space. So this figure shows the 90-day delinquency rate across subprime borrowers for different income groups. And you see that default rates are at historic highs for people who make less than $30,000 a year. And again, the rate of degradation is apparent in this figure compared to higher income groups. So it's not just subprime credit overall, right? It's subprime credit given to people who have a low ability to pay. And that is important in the context of these stories you hear about of lack of income verification, right? So I'm sure that people here are familiar with the Santander case, where only 8% of their securitized loans in a recent subprime deal were income verified, right? This shows how important that is because income combined with a subprime loan, that's recipe for really high defaults in the future. Right, and the way I think about it is that there's two outcomes, right? Either you know about it and you can price accordingly, or you don't know about it and you don't care because you think that you could, with fancy repossession technology, you can just get the car back and the default doesn't matter. And I think that both of those still support income verification where it reduces asymmetric information, right? It's knowing about this expected default pattern is just good for risk management practice. Now, one of the interesting things about this graph is the missing category. So this figure, the income is an Equifax-derived income using a model that they have. So a missing income means that they couldn't derive the income. So it's a thin file. They didn't have enough information about the borrower to estimate their income. And those 90-day delinquency rates have skyrocketed during those worst vintages that I just plotted. So again, it's incomplete information and perhaps a lack of income verification that's creating a lot of stress in the subprime space. Another cut of the data shows that young borrowers are having a lot of trouble when they take out subprime loans. So a lot of research that's been done suggests that millennials have it pretty bad. They have a lot of student loan debt. They have a higher rate of service jobs. They make 20% less at the same age than boomers did back when they were in their 20s and 30s. And they have inexperience with credit markets, right? So another interesting cut of the data is if you plot young people or people in their 30s who have a mortgage and don't have a mortgage, the group without a mortgage, the subprime group without a mortgage, their delinquency rates skyrocket, but with mortgage, they're pretty flat. So it suggests that young people, they're financially constrained and they're inexperienced with credit. And that's causing delinquency rates, again, to surpass what we saw during the recession under normal baseline conditions. So the other layered risk, so right now it's low income, right, perhaps a young borrower, and then the next risk that could add default, increase the probability of default, would be term, right? A lot of talk has been given to terms. So the fastest term growth has been in the 64 to 75 month category, and that now makes up about 46% of all subprime loans outstanding, subprime balances outstanding. But when you look at the default rate across the terms, you see that it's actually the really, really short terms that have the highest default rates, right? And that, again, really high monthly payment, a subprime borrower might not be able to accommodate that, so their probability of default is very high. You see, for what we've seen so far in the subprime group, normal performance deterioration in the longer terms, but in the longest term, the 76 plus month, the probability of default is actually very low. And part of the reason for that, right, very low monthly payment. Those loans are, the reason people want those loans is to be able to make their payments on time, right? So this suggests that in that capacity, it works to some degree. And a lot of our other research has found that the people originating those loans are oftentimes credit unions who have a very close relationship with their borrower. So before I was the auto economist, I built custom credit models for clients. And I was working with one credit union, and they had a 10-year car loan that they gave out. And they said there were only about like 15 to 20 of them, and they had 0 defaults, right? Because like those loans are extremely carefully underwritten, and then that relationship is managed over time, right? So it's in that very popular 64 to 75 month, you see normal performance behavior, but once you get past that, that's kind of like a special case, right? However, they're definitely not without their risk. And that's because average default amounts for that term are rising over time, right? So another way to think about that is the probability default on those loans is very low, but your expected loss given default is very high. And the reason is they're paying down that loan very slowly, right? And there's two things that could cause this trend. The first is bigger origination balances over time, and the second would be if borrowers default earlier on in their life cycle. Right, that would increase the gross losses in that term bucket. Looking at the data, it looks like it's average origination amounts. So the original balance on those loans jumped from 25,000 to over 30,000 recently. Right, so given how slow they're paying that down, that's pulling up the average default, the average loss on those loans. Whereas in the other groups, where the probability of default is more of a problem, the expected loss given a default is much lower, right? Because again, they're paying it down faster, right? There's two things going on there. And in the 64 to 75 month, it's cyclical, but it's leveled off, right? But the 75 month looks like it's trending pretty high over time. And then another layer of risk is geography, right? So the United States is a big place, and there's regional economies operate very differently. So for subprime auto credit, the subprime penetration rate in the South is much higher than the rest of the country. It's over 20% of all balances are subprime, whereas in places like Montana and Wyoming, that number is like around under 10%. So the South not only has higher subprime penetration rates, but they also have higher default rates for their subprime credit, right? So there's more of it, and it defaults more often. Now, the Southeast is one of the highest regions of the country for bad subprime credit performance. And the reason for that is that economy, especially Florida, right? There's lots of car buying activity going on in Florida and Miami. And I recently learned yesterday in a session that there's also, in Miami, there's a huge fraud ring there. There's fraud rings scattered throughout the country, and Miami's the #1 spot, right? And Atlanta, Georgia was another one. But it's the leisure and hospitality services that really define the South, right? Those are typically low-paying jobs. And on a variety of other metrics, the southern part of the United States performs worse economically than other places. The Northwest, subprime lending, like I said, is much more infrequent there. So their performance is better on those vintages. There's not so much of this competitive boom to suck up all the subprime borrowers there. In the West, obviously the tech market is really strong there, right? So they have an extremely good labor market and wages, and the similar thing can be said for the Northeast. But the Rust Belt is another problematic area. And the reason for that is manufacturing, right? That region's been decimated by manufacturing, and it shows in the ability of subprime borrowers being able to keep up with their payments. All right, so far we've established that it's the deep subprime non-bank loans that are performing really poorly, even in a good environment. Couple that with a lack of income verification, that reduces the inability to pay for if a loan's given to a low-income borrower, right? Young people, really short terms, and then being in the South, right? Those, like if you have a loan with those characteristics, that's a huge red flag. But so, given how much auto subprime debt is out there, right? $217 billion, which is the same amount before the recession. What can we expect going forward? So like I mentioned earlier, with creditforecast.com, we cut the data by all these different segments and we forecast it using macro models. So aggregating those forecasts up into the non-bank and bank channels, we can forecast what the subprime default rate is we expect it to be in the future. And obviously the non-bank is going to be higher, right? There's a deeper penetration of the deep subprime in that space. But our models are suggesting that we're at the crest of the current cycle. Right, so we're starting to see credit tighten. We're starting, performance is hitting historic peaks, right? And we expect that to round the corner. There's two reasons for that. So the first is auto loans in the grand scheme of credit are pretty short term, right? It's not like a mortgage, which is going to stay for 30 years. So a lot of that bad credit that was originating 14, 15, that's going to start running off of lenders' books, right? And then the loans that are defaulting right now are running off as well. And then on the origination side, if you look at those vintage graphs, we expect that to start to come back down to reflect the safe period back in 2011, right? So the new credit coming in is going to be higher quality, perhaps better underwritten. So we expect the default rate to fall, but it's not going to fall back to the trough before the recession, right? So this cycle, the cyclicality is much more mitigated. And that makes sense, considering that there's no serious exogenous global financial shock going on. In the bank industry, because they're not as deep into the subprime space, their cyclicality is much less, right? And we expect default rates to continue to perform because they're not pulling back as far. So if you decompose auto balance growth between those two segments, you see that non-bank is pretty much flat and bank is continuing to grow. So we're going to continue to see expansion in the bank space, but non-bank is going to start to curtail, and that's going to improve performance. But even though we expect to be coming down the downward side of the auto credit cycle, there's a lot of subprime defaults going on. So this shows the monthly amount of defaults coming from the subprime auto space. And as of 2017, it's about 1.5 billion per month, right? And that's consistent with the volume, even though the rate is lower, right? So the default rate is lower, but the volume is higher now. And with our credit forecast model, we can run economic scenarios to see like what these defaults would look like if there's another Great Recession, which is the green line. And we see that if that were to happen, subprime default balances would go up to $2 billion per month, right? That's a non-negligible number, and that's also higher than anything we've seen in the history of the data. So that's something to be aware about, right, is that even though there are these layers or pockets of the subprime space that you see performance much worse than others, right, these are good economic conditions, right? And if things were to go bad, the industry could see a significant decline or significant increase in the amount of defaults they're seeing in securitizations and throughout the industry. But under baseline conditions, right, that cycle is going to bring it down, but then it will continue to rise as auto credit expands over time. All right, so with that, are there any questions?
I have a question.
Sure.
2 slides back. What is your assumption on the underwriting pullback when you're saying that the default rate is going to go back, go down?
Mm-hmm.
How much pullback is there? A percentage level?
Sure. I don't have that number off the top of my head, but I could easily follow up with you about that. But if you plot our origination forecasts, you see that they curtail significantly, right? So this is a peak right now, and then over the next 2 years, you see it drop. By how much, I don't know off the top of my head, but that's one of the inputs that's feeding into this model.
So originations overall is going to continue to drop?
Mm-hmm. Yeah, over the next year or two. Yeah. All right, well,
Another question on the non-banks. Is your funding coming primarily from private equity? Or those?
yeah, so that's true in a lot of cases. But admittedly, it is difficult to distinguish those two channels, right? Because a lot of those loans get mashed together in securitizations, right? So it's like you could have a bank that buys up loans from non-bank channels, right? And then it appears like they're bank originations, but they actually came from a different source, right? So in that case, they're getting lift from the securitization.
What are you finding in the organization? Is that pulling back as well?
So admittedly, that's not my area of expertise. That's much more on the MIS side, the bond rating side. But I know for them, they've been doing a lot of work in this space because they're concerned about this level, right? So it's you see things like the 32% deep subprime penetration in subprime deals now. Like that's a red flag for them, especially because that's the group that's doing the worst. And not only in level terms, right? It's over time, it's accelerating. So that is a big concern for them. All right, well, thank you very much.